Hi everybody, and welcome back to video number 3 in chapter 21. And when we left off, we were looking at putting into practice uh, changes in accounting principle for the first part of this, which was the entry to record the accounting change at the beginning of 2025. And as you can see here, we get these numbers from here and here and here. And that is a combined effect of 2023 and 2024. So you'll recall that the percentage of completion method, gross profit is recognized over the course of the construction period rather at a point in time than being recognized all at once at the completion of construction. If percentage of completion had been used from the start, Denson would have reported $220,000 more income, resulting in $44,000 additional tax for a net increase in income of $176,000. The credit to deferred tax liability represents the adjustment for temporary differences arising in prior years. In 2023 and 2024, taxable income using completed contract is less than pre-tax financial income using percentage of completion. As you learned in Chapter 18, this temporary difference creates a deferred tax liability. Construction in process is the asset account impacted by the change to the new accounting principle. Recall that under percentage of completion, gross profit recognized each year is debited to construction in process. Therefore, if percentage of completion had been used from the beginning, the balance in the construction in process account would be $220,000 higher. By debiting construction in process for $220,000, the account is now up to date for 2025. So going back to instructions for Part Bravo here, they want you to prepare the comparative financial statements for 2025 and 2024 using the percentage of completion method. So if I jump here, Denison's financial statements comparatively would reflect as follows. And the income statement for percentage of completion method show net income at $160,000 and $144,000 for 2025 and 2024 respectively. Retained earnings statement, if the percentage of completion had been used in 2023, retained earnings would have been $160,000 higher. This is reported in the retained earnings statements for 2024 as follows. So here you see in red, we have added the adjustment for the cumulative effect on prior years of applying retrospectively the new method of accounting for construction contracts here at $160,000. So we then ripple through the ending retained earnings as follows. Okay, one thing here, that $1,680,000 is comprised of $1,360,000 plus $320,000. So that would represent retained earnings using the percentage of completion method of $1,840,000, and then using cost recovery method, $1,680,000, That difference is the cumulative effect difference here of $160,000, which is shown here and here. Okay, let's look at describing the accounting for changes in estimates and changes in the reporting entity. Examples of estimates. There are several. 1. Uncollectible receivables. 2. Inventory obsolescence. 3. Useful lives and salvage value of assets. Number 4. Periods benefited by deferred costs. Number 5. Liabilities for warranty costs and income taxes. Number 6. Recoverable mineral reserves. And 7. Depreciation methods. So, if we look at prospective reporting, changes in accounting estimates are reported prospectively. We are going to account for changes in estimates in 1, the period of change if the change affects that period only, or 2, the period of change and future periods if the change affects both. The FASB views changes in estimates as normal recurring corrections and adjustments and prohibits retrospective treatments. All right, let's take a look at an illustration. Here, Underwriters Labs Incorporated purchased for $300,000 a building that had originally estimated to have a useful life of 15 years and no salvage value. It recorded depreciation for 5 years on a straight line basis. On January 1, 2025, Underwriters Labs revises the estimate of the useful life. It now considers the asset to have a total life of 25 years. And we're going to assume that the useful life for financial reporting and tax purposes and depreciation method are the same. So the question is, what journal entry would you prepare to record depreciation expense in 2025? And the solution for that is that we will be using the straight line method. Depreciation expense has been $20,000 per year. That's this $300,000 divided by its useful life of 15 years. The book value of the building at January 1, therefore, is as follows. Here's the original cost, and 5 years at $20,000 a year is $100,000. So the book value at January 1, 2025 is $200,000. So in 2025, Underwriters Labs changes its estimate of a useful life to a total of 25 years. Since 5 years have already passed, 20 years remain to depreciate the building. So we're going to take that $200,000 here and divide that by 20 years, and that's going to be $10,000 per year. So for 2025 then, they're going to record depreciation for the year as follows. Depreciation expense, $10,000. Accumulated depreciation on the buildings, $10,000. And depreciation is going to continue at $10,000 per year unless another change in estimate is made. Underwriters Labs accounts for this change in estimate in the current and future periods only. All right, so differentiating between changes in estimate or principle. The companies sometimes find it difficult to differentiate between a change in estimate and a change in accounting principle. So here, if it is impossible to determine whether a change in principle or a change in estimate has occurred, the rule is this: consider the change as a change in estimate. And those are referred to as a change in estimate affected by a change in accounting principle. Let's take a look at the Rush Company as an illustration. So Rush Incorporated changed depreciation methods in 2025 from double declining balance to straight line. Depreciation prior to 2025 under double declining balance was $180,000, whereas straight line depreciation prior to 2025 would have been $100,000. Rush's depreciable assets subject to the change had a cost of $500,000 with an $80,000 salvage value and a 10-year remaining useful life at the beginning of 2025. The question, therefore, would be, what entry would you recommend Rush make in 2025, if any, related to depreciation of these assets? So if we look at the solution, the journal entry for depreciation is as follows. We'll take the $240,000 here and divide it by the 10-year remaining life. And we got that by taking the cost of the depreciable assets initially at $500,000 given here. We'll back out the $188,000 of double declining balance depreciation here. And that gives us a carrying value at the beginning of January 2025 of $320,000. Back out the salvage value of $80,000, and that gives us a depreciable base of $240,000, which we then will divide by the 10-year remaining life, which will give us $24,000 per year. And therefore, we'll debit depreciation expense, $24,000, and credit accumulated depreciation, $24,000. This is a change in estimate affected by a change in accounting principle. As a result, there is no adjustment for prior year effects. Rush determines depreciation expense in 2025 and future years on a prospective basis. Okay, differentiating between an estimate and a correction of an error. A similar problem occurs in differentiating between a change in estimate and a correction of an error. Proper classification is important because the accounting treatment differs for correcting errors versus changing estimates. So, number one here, the general rule is companies should consider careful estimates that later prove to be incorrect as changes in estimates. Number two, only when a company obviously computed the estimate incorrectly because of lack of expertise or in bad faith should it consider the adjustment an error. Let's take a look at a disclosure of a change in estimated useful lives here with this illustration. It shows a disclosure in estimated useful lives, which appears in the annual report of Microsoft. And here's their note. And they basically say that here are our accounting policies, estimates, and assumptions laid out very nicely there. I'll let you read that on your own. And then for disclosures, company need not disclose changes in accounting estimates made as a part of normal operations, such as the bad debt allowance or inventory obsolescence, unless such changes are material. However, for a change in estimate that affects several periods, such as a change in the service life of depreciable assets, companies should disclose the effect on income from continuing operations and related per share amounts of the current period. That looks like a good place for us to stop this video. And when we return, we'll take a look at changes in the reporting entity. Until that time, bye for now.